You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Hope you're doing well on this Tuesday. So, yesterday we discussed how to find out the real reason why your stock in your portfolio is down. So I gave you a framework. So I suggest that you go back and listen to this episode because I think it's going to be quite useful. And I thought, well, why don't we just start using that framework for one of my own holding and see what's going on and if I should be patient or not with this one. So I decided to take a look at Brookfield Renewable, BEP, BEPC, depending on which market you want to buy it. Long story short, you have the choice between trust units or corporate class shares. So like classic shares as any other companies that would come with BEPC. This is the one that I have in my portfolio. Mostly, I have it in my Libra account, so it doesn't really matter. But if you are looking for tax optimization, probably that you would like to have dividends instead of distribution. But again, that's really up to you. That's not the goal of this podcast. So, why BEPC? Well, I've been holding this one for a few years, and definitely it has been a quite frustrating holding to have in my portfolio. The reason being, the stock right now at the time of recording is down 12% in my portfolio. Of course, if I calculate all the dividends I've received, I'm probably close to being even. But even then, after like 3 years holding the stocks roughly, and you're like breaking even while the rest of the market has been up so much over the past 3 years, it's definitely not a good company. So I thought it was a very interesting selection to do that work, mostly because it's not a catastrophic stock where I'm losing 50%, the company is slowly dying, and it's on the verge of a dividend cut. Actually, quite the opposite. So while BEPC did nothing over the past 3 years and the Canadian market is up like 29%, now you have to look at the framework and see what's wrong with this company. So obviously, it's not the market. Just said it. BEPC total return for the past 3 years is roughly zero, and then the stock market is like on the Canadian side is about up 29%. So definitely that's not it. In terms of sector now, yes, renewable energy has not been seen as a great investment after 2021. So we had a big peak right after COVID. And after that, it was downhill for a lot of companies. You can think of like Northland Power, NP High, that is down like 40 something percent. 47% over the past 3 years. Energex, renewable energy, INE, that has been down 53%. So when you consider other renewable energy stock on the Canadian market, maybe you're thinking, well, it's not that bad. Even Nexera Energy on the US side, which is the largest renewable utility in North America, is down by almost 4% over the past 3 years, while the S&P 500 is up by 37%. So definitely Brookfield is doing better than the industry, but it's not necessarily doing that well, right? So again, I'm thinking, okay, so there is an explanation around the sector. There's a lot of a lack of love around renewable utilities. So the first step here is to ask yourself, why investors are not interested in investing in those companies in the first place. It used to be a big trend. We keep on talking about green energy and being more green, recycling, and all those stuff. So why don't we just invest more in renewable energies, right? That doesn't really make much sense. But the thing is, the technology cost a lot, and with inflation, building wind farms or solar panels, and yet alone like constructing hydroelectricity barrage, that is like even more costly than anything else. So the cost of those projects versus the efficiency of the energy created, very very hard to keep up with something as easy as doing like natural gas or burning coal. Actually, even though we're trying to cut down coal across North America, still super easy to produce electricity from this, while other sources like wind, solar, and hydroelectricity, it's a lot more complicated, less efficient, and the industry depends a lot on government subsidies. So there is still a place in the market. Well, a lot of investors are thinking, well, if you need subsidies to be profitable and grow, that's probably not a sound business model. And I have to agree with that. So again, that is also waiting right now. That's kind of like the bear thesis around the renewable industry. Digging a little bit deeper, what about the company? What's going on with Brookfield Renewable? So what I like to do is always like to lay out my investment thesis and then verify if my thesis, that like the reasons why I like that stock, is still valid, like it is backed by numbers. So when I look at like the big lines here, because when we have to do fast, well, the playbook for renewable energy for Brookfield, it's great. It is backed by Brookfield Corporation, so it has access to plenty of money. And what they do is they do a lot of asset recycling. So they buy an undervalued asset according to their calculation. They make it better, they run it at a profitable stage, and then they sell it at a profit, and they use the proceeds to do again like kind of like building this flywheel of reinvestment into other long-term utility assets, building them, selling them at a better price, and so on. So that's a great way to do it. Another growth vector is definitely the need for more energy. With the rise of AI, the rise of cloud and data centers, the companies are requiring a lot more energy, and that demand will continue to grow. So of course we can still rely on fossil energy, but at one point we will need the influx of energy coming from other sources. So here comes renewable energy. And finally, Brookfield is super well diversified across different sources of energy, which I like. I also like the fact that about 50% of their business model relies on hydroelectricity, which is a little bit more stable than wind and solar. They have a long-term contract, which offers kind of like a good protection. Those contracts, of course, includes escalation rates. So, and when you look at their quarterly earnings, you will notice that. You will notice that most of the time, every quarter, the funds from operation and the funds from operation per unit is going up, mostly based on contracts that are raising prices every year. Now it's time to look at the numbers. So, are the numbers are working well? Well, actually, they do. And Brookfield Renewable reported their latest earnings not too long ago. FFO per unit was up 21%. The company announced another 5% dividend increase. They are online. They have reaffirmed that they believe they will continue to grow their FFO per unit at an annualized growth rate of 10%. They're quite optimistic about the future. They do have those inflation-linked pricing adjustment into all their contracts. Revenues up. So from the metrics point of view, everything looks good. Revenue keeps on growing. The funds from operation keeps on growing. The FFO per unit grows. So that allows the company to fuel more money, like do asset allocation to buy more utility assets and make more deals, but also to reward shareholders with dividend increases. So one last downside for Brookfield, though, is the fact that the company works with funds from operation calculations. So the FFO is kind of like a homemade calculation. It's not perfect. I wish we could use earnings and EPS, but we cannot due to an amount of deals that they're making. So buying, selling assets that will have a huge impact on earnings, which would not necessarily have a huge impact on their cash flow. So using the FFO is probably better, but the fact that it's management providing us those numbers and it's quite complex to dig into each of Brookfield's company inside the business. This is one thing that if you don't like this part, this is not a type of business for you. Of course, it will also put a lot of force investors to stay on the sideline, even though they could be interested in this one. So the verdict on this one right now, I still keep it because the numbers are backing my thesis. So even though the stock price is not going up at this point, I do not judge the company's quality in my portfolio based on short-term performance. As long as the numbers will be there, I will hold BEPC. Again, that's just me, but that's part of my investment rule, and I found it very important to stick to clear investment rules. All right, Moose, that's enough for today. Tomorrow, we're talking about TFSA and what to put in a TFSA, like what's the best strategy. There are a lot of things, and I thought of talking a little bit more about this for tomorrow. All right, guys, so don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.